I have a confession to make. I hate articles and videos where a simple list is provided, and by the end, I've learned nothing of substance. So I say that, and here you are watching my video with my 7 stock list of purchases we made this past week. But I am going to treat you the way I expect to be treated, and I hope that you learn something of substance about these 7 companies. So we've had a busy few weeks. Casey and I have compiled a ton of notes from earnings reports, quarterly filings, earnings call transcripts, and I just want to share a few points because in the wake of these few weeks, a number of our favorite companies, their stocks sold off, some of them quite a lot. So we went shopping this week. Some of these were just our normal monthly dollar cost averaging plans. Some of them we got a little more aggressive with than usual. Let me share with you the 7 businesses that we bought and why. Before continuing, let me remind you to hit the like button and subscribe to the channel if this video is helpful as you do your own investment research and increase your knowledge of business and technology. We really appreciate the support, as subscribing to the channel helps us continue putting out content like this. You'll of course notice that these first 4 stocks are not semiconductor stocks. That's because we started this channel not because we wanted you to go all in just on semiconductors, but just simply because we feel like this is an underfollowed industry. We actually run a well-balanced portfolio. Thus, here's the first 4 stocks, non-chip stocks. Hopefully you learn something a little bit more about our process along the way. The first one, pretty plain vanilla Alphabet. We buy Alphabet C shares, so ticker symbol GOOG, G-O-O-G. So all of this AI nonsense is completely overblown in our minds. Microsoft pulled an absolutely brilliant marketing stunt, and it's worked for a few months here with ChatGPT. I mean, it feels like we personally cannot escape hearing about ChatGPT everywhere we go on the web to get some information, to get some data. Of course, earnings calls completely full with AI, dropping that, CEOs and CFOs dropping that word like it's going out of style. Microsoft's captured the spotlight, but of course, Google was going to steal the spotlight back. Of course, they were going to respond. And so we actually picked up a couple more shares. We've been buying Google stock for a year now on a monthly basis. We picked up a couple more shares ahead of the I/O conference, and the market was pleased with what they heard at Google's annual developer event. Lots of services are getting this generative AI facelift, including Google Search. It looks like Bard, which got off to a pretty poor start, has gotten some great upgrades. They're going to embed that in Google Search. Lots of other services from Google going to get infused with their large language models that they actually pioneered. It was actually Google that helped make some of the stuff, and Microsoft is now benefiting from it. So not a surprise here that Google has struck back and the market was pleased. Stock up quite a bit this week, especially after that I/O conference. But more specifically, what we liked, it was after the last quarterly earnings results. It looks like the digital ad market is bottoming out and is showing signs that it is going to return to robust growth later this year. One highly underestimated part of this business, though, is Google Cloud, which is a small but not insignificant part of the business. But in the first quarter, it flipped from an operating loss to suddenly an operating profit. This is going to have a huge benefit on Alphabet's overall profit margins going forward, because you have, again, small but not insignificant business going from deeply in the red last year to now robustly profitable. So we think Alphabet is going to return to growth by the second half of this year. And we see profit margin improvement coming as well. Again, Google Cloud, the primary driver of that, but also the strength of the US dollar versus other currencies. It looks like that is now going away. So that's no longer a headwind as well. At this junction, we think Alphabet's fair value is about $120 a share. So this isn't the most timely of buys, but bear in mind, my fair value estimate anticipates some pretty depressed earnings per share and free cash flow per share growth over the next 5 years from Google. I'm talking high single digit average per year growth using a discount rate of 11% on my cash flow analysis. A fair value of $120, but I think there's lots of upside from here in the years ahead for Alphabet. Stock number 2 that we bought a little bit of early this week, Airbnb. This company has accomplished so much in just a few years since their IPO, and we still feel like it has so much to gain. Yes, admittedly, there are a myriad of issues, but that's how investing works, especially with a company that's really only just over a decade old. This is a young business. In spite of its size, you can expect there to be lots of imperfections. But I am a firm believer that businesses are problem solvers and that businesses that solve problems will make money. They'll make more money. They'll get more profitable over time. And eventually the stock price will reflect that. So we actually liked the stock after the sell-off. We actually made our initial purchase of Airbnb late in 2022. So we are adding to it here. We thought it was a good quarter. Obviously, the free cash flow generation was kind of the headline. That will probably ease going forward. The company's not going to generate 80, 90% free cash flow profit margins every quarter. This was a one-off. Nevertheless, in spite of the sluggish revenue growth for Q2, 12% to 16% year over year growth, not surprising given where the economy's at, but Airbnb still a long-term growth story. And you got to like those stock buybacks. They repurchased $493 million worth of stock in the last quarter alone. All the things that made Booking Holdings, previously Priceline, a great investment in the 2000s and 2010s are now in play for Airbnb. This is an incredibly efficient business with tons of upside. Fair value, by my estimate, about $125. Again, that's just factoring for current estimates over the next 3 to 5 years. I think over the next 3 years, we're going to see earnings growth of about 20% before it goes down from there. Given that, fair value, $125, but we like Airbnb for the long haul. Number 3 is Twilio, ticker symbol TWLO. Admittedly, this one is super ugly. It's a mess, but one that I think is highly misunderstood and has had a ton of negativity heaped on it. And much of that negativity is pretty superficial, pretty surface level analysis. Right here, I'm going to embed the link to the conversation I had with my friend Rahul Sethi a few months ago. We think that what we talked about a few months ago about Twilio is still very much the situation and still in play. This one needs a gradually changing narrative in the coming years. But when it dipped back below $50 a share on Tuesday following the earnings report, I couldn't resist. Revenue growth was up only 15% year over year. Not bad considering economic headwinds. Expected Q2 growth of 4 to 5%. Not great, but again, we were kind of expecting this for Twilio this year. But a few positive signs. Active customers actually increased to 300,000, up from just 268 the same quarter last year. And the company, though it did report negative free cash flow again this quarter, still expecting positive free cash flow this year. And the company has begun repurchasing its stock to offset stock-based compensation. Now, as far as SBC, stock-based comp goes, it was $171 million this quarter. That includes restructuring charges. Remember, this company laid off a huge chunk of its workforce the last couple of quarters. So 171 million in SBC, that is up from 155 million last year, same quarter last year, but we think this number will begin to gradually reduce going forward because of those mass layoffs. But they have executed $250 million worth of their 1 billion total stock repurchase authorization. And they did also increase the low end of their adjusted operating profit outlook for 2023. Previously, the low end of that guidance was 250 million. It's bumped up to 275 million now. And they think they can generate as much as 350 million the end of this year. Company still has cash and short-term investments of nearly $4 billion, another 680 million of long-term investments, offset by debt of only 988 million. We expect big operating margin leverage coming in the years ahead. I really think this company can start to generate free cash flow margins of 20% within the next few years. Again, the narrative is going to need to change. The market's going to need to change its mind on this one for the stock price to permanently reflect that. But at any rate, this is a small bet that I'm willing to take a slightly bigger bet on after that earnings update. Number 4, PayPal. PayPal stock tanked like 12%, 13% after their first quarter earnings update. This one really just illustrates market insanity. The collective human mind does wacky things and thinks wacky things. Okay, so here's what's happening with PayPal. So, as you know, PayPal also owns Venmo, and those two apps together make up the bulk of their payment volume. And they earn basically a fee every time someone uses certain PayPal and Venmo transactions to move money around. But they have this other business called Braintree. Braintree competes, it's a very small business, but it competes with Adyen and Stripe, the privately held company Stripe, in what's called unbranded merchant payment processing. So basically, this is a merchant that wants their logo on the checkout process, but it's still PayPal, powered by Braintree, behind the scenes processing that transaction. But while you're making the purchase, all you see is the brand that you're making the buy from. So this unbranded business division for PayPal, it's profitable, but it's a lower profit margin than the PayPal and Venmo apps. So Braintree is basically growing a bit more than expected, about 30% growth from this Braintree unbranded merchant processing business. That caused management to increase its adjusted earnings per share outlook for 2023, but simultaneously lower their profit margin expansion. Previously, they were expecting a 1.25 basis point increase. They reduced that to just a 1 basis point increase for the full year because of Braintree. So my question, I guess, to the market is, what did you want? Did you want PayPal to just walk away from the profitable Braintree business and realize little to no growth? Would that have made the market happier? Come on, that's ridiculous. PayPal is still managing to grow at a high single-digit percentage growth rate, highly profitable by all metrics, including free cash flow. And the stock does trade for under 15 times free cash flow. It looks cheap to me. My current fair value estimate, about 75 to 80 bucks. But again, that's with some depressed forecasting over the next 5 years, expecting just 4 to 5% earnings per share and free cash flow per share growth over that period of time. I think it's a very low bar to clear. We're PayPal buyers. Okay, stocks number 5 and 6, you should be familiar with here. We're going to put a link to the last videos we've done on Synopsys and Cadence design systems below. Remember, these two companies make up the bulk of the EDA market, or the electronic design automation market in the semiconductor industry. Basically, these are chip stocks, but they're software-based chip stocks. So, as we've mentioned before, these two ridiculously valued, but they're on our dollar cost average list. So we made our monthly buy anyways, but like April, because of the big run up in stock price year to date, we only bought a small handful of shares of each of these companies, because that's how dollar cost averaging works. You make the buy regardless. And when the price is up a lot, you end up buying fewer shares versus when it's down. So we added to these two. We expect, though, to have a full position by the end of this year. And for us, what that means is both stocks in combo will equal at least 2% of our portfolio. We'll provide some more details on that going forward, but we're more than happy to continue building this position because we think both of these companies are going to realize steady double-digit growth over the next 5 years, probably at a low teens rate. Both companies, especially Synopsys, but also Cadence Design to a lesser extent, also increasing profit margins, repurchasing stock. We still think these are some of the best ways to bet on the AI craze in the coming years. So great businesses, ridiculously priced stock, but one that we continue to nibble on. And number 7, speaking of ludicrously valued stocks, Lattice Semiconductor. So teaser, we actually will have a longer video coming on this one next week that highlights Q1 earnings results. But in a nutshell, it was another awesome quarter. They guided for another awesome quarter in Q2, but the market was clearly taking profit on this one. This is another one that ran up a lot since the October-November 2022 lows, but it went from a high of about 94, 95 bucks a share down to 80 bucks. So we finally nibbled. This is not fear of missing out. I've actually been sitting on my hands watching Lattice Semiconductor for the last 4 years, haven't purchased a single share, and I continue to like what I see from the business more and more. Their CEO doing wonderful things, and I think this FPGA chip designer is doing some pretty great things. I think they're taking market share from some key competitors, from some non-FPGA chip companies. So we'll talk about that next week. Again, another teaser. I think the fair value on this is currently actually about 70 bucks, not 80 bucks, slightly over 80 bucks where we actually made the initial purchase. But stay tuned. I'll share why we started buying Lattice Semiconductor anyways. That's a wrap. The 7 stocks that we bought in this last week: Alphabet, Class C, ticker symbol GOOG, AirBnB, ABNB, Twilio, ticker symbol TWLO, PayPal, PYPL, Synopsys and Cadence Design, SNPS and CDNS, and a brand new stock for us, Lattice Semiconductor, LSCC. Please remember, do your own due diligence. Don't buy something simply because I said we bought something. Also, remember, diversification is important, and not just buying a bunch of stocks and calling it diversified. Be thoughtful about how you construct your portfolio. Whenever you add a new position, what you should be looking for is something that is quality and also something differentiated that brings something new to your portfolio that's going to add something that you don't already have in the mix. So bear that in mind. Don't be a stock picker, only be a portfolio constructor. But those are our 7 stocks. We've got more stock and business coverage in the semiconductor industry coming next week. We're going to do some more videos where we compare different parts of the semiconductor industry, different businesses, and share some pros and cons of each business model. And I know it's taken a long time, but we are still working on that semiconductor fab equipment index. That is still in the works. It's still coming. I apologize. Earnings has gotten Casey and I off track a little bit on that, but expect that here real soon. Have a good weekend, everyone. Take care.